Peace and power, and welcome back to Katie's Alchemy. My name is Nina, and I'm Katie's granddaughter, and I'm here today to share with you some more information on the Forex market. And so today, what we'll be going over is what is bearish and what is bullish. We've all heard the terms being used by traders around the world, and so we just want to make sure everyone has a clear understanding. And so it's going to be a brief video just describing to you what bearish and bullish is. So, what is a bear market? A bear market is a market in which the prices of stocks or bonds are failing. In fact, a bear market could describe any market, including oil or real estate, if the prices are declining. That means the market is going down. Now, what is a bull market? A bull market, on the other hand, is the opposite. In a bull market, the price trend is upwards. So, why do we say bear and bull markets? It it is all to do with how the two animals attack, some people claim. While the bears swipe down with their paws, the bulls thrust upward with their horns. So the bear market could also have come from the London bearskin jobbers. Jobbers were people who sold bear skins. However, they sold the skins before catching bears. Jobbers' actions clashed with the French saying, "Don't sell bear skins before you have killed the bear." The French expression, which was like, "Don't count your chickens," was a caution against over optimism. Now, by 1721, during the time of the South Sea Bubble, the bear was linked to short selling. Jobbers sold bears they did not own, expecting prices to fall. Subsequently, they could buy them later on at a greater profit. If you are bearish, it means you are pessimistic. You're pessimistic about the market. However, if you feel bullish, you are optimistic. One of the most famous bear markets in history was the Great Depression of the 1930s. What causes a bear market? Simply put, a bear market occurs when there are more sellers than buyers. If any free market system, when supply exceeds demand, prices fall. In a bear market, for example, the sellers are the supply while the buyers are the demand. Hence, when the market is bearish, sellers' numbers are high, but a buyer numbers are comparatively low. How does one know when this is about to happen? Predicting whether markets will rise or fall is extremely difficult. In fact, most experts say it's impossible. However, understanding what factors shape the market can help. We know that three situations cause a bear market. First, a rapid rise in the inflation rate. Second, high unemployment rates. And third, an economy that is entering a recession. There are also psychological factors such as our herd instinct. For example, if some investors see many others selling, they may do so too. Then others hear that the first and the second group of investors were selling and they do the same, etc. And so you want to invest when you invest in a bear market. How can you reduce your exposure when there is a bear market? One way is to sell all your shares and buy short-term government bonds. In other words, get rid of your investments in securities and find safer options. However, it is possible to continue investing in shares during a bear market. For example, the blue chip companies with impressive profits are more likely to do well in an economic climate. Okay, so it goes on to share with us that when the stock market trend is downward, which is a bearish market, you should avoid smaller companies. Above all, stay away from startup companies. Companies that are just starting don't usually have the financial security to withstand poor market conditions. In a market full of bears, we call solidarity we call a solitary bull a contrarian investor. Likewise, a solitary bear in a market full of bulls is also a contrarian investor. Now, according to NASDAQ.com, a bear market is any market in which prices exhibit a declining trend for a prolonged period of time, usually falling by 20% or more. So, what we just recently saw, which is a good example, was the decline of Bitcoin. It went all the way down for a long time. I mean, it was weeks of a bearish market. And so, when prices are either stagnant or falling slightly, investor uncertainty may grow. This can lead to too many seller orders and too few buy orders. We often refer to this situation as a heavy market, and we saw that going on. Bitcoin was down, and a lot of people sold because they didn't think it was going to recover. And now we're watching Bitcoin get up fast. In the last past couple of weeks, it's up to almost 50,000 again. And so this would be a good example of a bearish market. And again, this video was just about what is a bearish market versus what is a bullish market. I'm Nina, Katie's granddaughter. Peace and power, and I'm out.